Okay, so on this episode of Finance Musings, I'm going to be reviewing and kind of doing a deep dive on Barron Capital's Q4 investor letter. And this letter isn't actually by Ron Barron himself, it's by another portfolio manager, Michael Lippert. And this is actually one of the best investor letters that I've read in a while. And I'm not no cap. I mean, read all of Howard Marks' stuff. I read a ton of folks, and I think this letter by Michael was outstanding. And I think there are three things that you can take away, learn from this letter to help you be a better investor in 2022, and just how you think and look at the market in general. And so definitely read the letter. I have the link in the description box, so please go and do that. And then obviously when you watch this video, you'll have some key takeaways, as you kind of go through the video, right? So the three big things that I'm gonna break down in this video and kind of follow along with the investor letter that I want to speak to are the following, right? So one is that what they do, when I say they, I'm referring to Barron Capital and what this fund is exactly doing. So this, for context, this is their growth opportunity fund. So think of it like as a proxy for ARK or like a Russell Growth Index or something like that, right? But excuse me, that was appalling and disgusting. I apologize for that. But so there are three things that they touched, right? One is investors reacting to changes in interest rates and inflation, and what does that do for market expectation, and how does that impact one's view of a company's fundamentals, or should it, right? And that's kind of the big thing, and I don't think it should, but that's one thing. The second thing is that, hey, what are the impacts that the Fed's actions can potentially have, now whether that's bond purchases or tightening, so whether it's quantitative easing or tightening on the flip side, and what sort of impact does that have on the market, and what does that mean for how you approach things, right? And then the last two things are, there's obviously a very clear rotation, right, where we're seeing market sentiment changing materially, right, in terms of a sell-off in growth stocks because there is the need or the desire, a yearning for stability, right? Or some sort of earnings yield that can be predictable, quote unquote, safe. And is it true that external noise is just that, right? External factors are just a noise in the end, right? So whether that's the political climate in DC here in America, geopolitical factors in China, the Russian invasion of Ukraine, how does all that impact us, and should it, right? So diving right into the letter, they have it broken out into seven really good subparts. And the first part that Michael writes about is, hey, should we be worried about fundamentals, right? So like, hey, these growth names that we have in our portfolio, should we be worried about the companies and are they deteriorating, right? So I'll give my take after I kind of touch on what he's spoken about in here. Now, what we're seeing right now in the market is a lot of people are leaving, at least for now, industries with higher NPV cash flows or higher cash flow potential in the future, which is driven by long-term growth, for more earnings security today. But here's the thing, is that while that may be well and good now in terms of like, hey, I don't want to chase growth in the future because I don't know what the future is going to hold and the future could change. So I'm going to try to focus on names that are more dependable and durable in the present. But something that he argues in the letter that I also vehemently agree with is that the change is here to stay, right? COVID accelerated a lot of digital trends and transformations that we're witnessing, right? There's no going back. So for example, you look at how e-commerce has expanded, right? Grocery delivery, the streaming wars, virtual meetings, video game penetration. And this is actually something no one is talking about. Like I read Barron's, I read investor letters, Seeking Alpha. No one, I mean, grants interest rates daily. No one has talked about the rise in women gamers. If you go and you look at Twitch numbers of women gamers, women streamers, and that market penetration, I think that is going to be huge because women buy a lot of shit, right? So I'm just trying to think of like, how does that impact retail game sales? How does that impact Pinterest stock? Because maybe there's gamers who now are selling recommending things to buy on shops or carousel via Facebook, IG, on Pinterest, on Etsy, gaming themed apparel, because women gamers are booming. And that's just a little bit of a tangent, but that's important to think about, because what COVID has done is that there is this longer term adaptation to these digital trends that are now being absorbed into consumer behavior. And it has now penetrated across age ranges. And think about the teenagers who have grown up in COVID. These things are going to be their way of life, of like, hey, I expect to work from home. I expect to have things on demand when I want it. And those are secular trends that are not going to change, right? If anything, there's going to be tailwind behind it, just pushing them forward, right? And that sort of penetration is good, right? That just means that, hey, that's strong growth rates, top line growth, which drives revenue, which, trickles down and drives cash flow. So again, I agree with him on this. I think this is 100% is very true, is that, hey, like, my take on this is also like, look, this is not an underlying issue in terms of like company strength, market trends, secular themes, so what's the issue? Why is there an overreaction? I think there's just too many investors that are worried about chasing yield for right now, right? But again, it's like, it's so dependent on portfolio allocation, portfolio weight, when you're retiring. There's so many factors, right? That, you shouldn't be rotating out of security just to do so, right? Unless there's like severe actual structural concern to the company. But the problem is that there are a lot of short-term traders that are obviously making a lot, and a lot of short-term traders who are trading a lot and not making money. But these moves obviously impact the market, and it is what it is. But one, I completely agree that if you're worried, you should not be worried about the fundamentals of any growth companies. That's just, and look, not any, let me clarify, strong names that have good operating margins. What are their unit economics? What does their cash flow generation potential look like? So on and so forth, right? The second thing is inflation and interest rates, right? And we already know it's April of 2022. We know what the Fed is doing. We know that, hey, we know rates will rise. Balance sheet's going to get normalized to an extent. But what I love, and I don't know who says this quote, there's some Harvard economist, and this is a really important quote, right? Let's see if I could highlight this so folks can on the screen see it, is that, we have two classes of forecasters, right? Those who don't know, and those who don't know, they don't know. And I think this is really important to think about, is because you can forecast and you have to, right? You're doing a DCF, you're projecting out free cash flow, projecting out expenses, top line growth. Excuse me. You're projecting things out, but you should do so knowing that you don't know what's actually going to happen, right? And that's why I think it's really important that a lot of economists, a lot of sell-side institutions and research folks, that there's no one on the planet who can take all this information in real time of like, hey, we have this complex just-in-time supply chain system. We've just come out of a pandemic. We have built up demand in our supply chains. Things are broken. We have a war going on in Europe, which is crazy that those words are coming out of my mouth, by the way. Like, let's not pretend that. We have this imbalance of these stimulus benefits that have like now peeled off, and how does that affect certain things that are cooling down? There's so many things that are going on concurrently that there is literally no point trying to predict the unpredictable. And that's what, Michael writes here. And it's like, instead of worrying about, hey, what are interest rates going to be, this, and that, which is noise, which is like literally shit that does not matter, why not focus on what matters for a good company, right? Growth trends that will drive economic growth in the future, net of short-term market factors and stock market movement. So it's like, hey, putting aside the noise, what are the trends that are going to matter to economic growth for a company? So what that means is like, who are the companies that are going to be leading the way in certain industries or sectors that we believe there are mega trends going on, right? And we'll get into that a little bit later, because they also have a nice section in the back of the letter that they break out. So let's ride these trends. Let's ride these companies that have profitable business models, good unit economics, good margins, etc., and the right management team in place. Ideally founders, or ideally folks who have done this before, right? So that's the second point. The third point, and this is a great story that I guess Ron Barron had in his older letter that I haven't read, but it's from September 30th, 2020. And the question is like, hey, should we try to trade in this environment? Trading for gains, whether you're shorting or any sort of short-term trading to take advantage of the chaos in the market. Or, oh, thank God, my XLR cables and Jesus. But this is what he said, and I'm going to paraphrase a little bit. So I guess Ron was telling Michael at some point, whatever that work, he's like, if you sell your shares, before the sell-off, if you sell your stock before that, and let's say things go the way you predicted, you're going to be afraid to buy back in, right? Because you're like, wait, the bottom still is going to come. And then let's say the contrary happens. Well, in that case, you're going to think that you're wrong and you won't buy back in either. So if we stick with the first point, it's like if you sell, you're going to have now sacrificed. So again, a recap, if you sell stock at what you think is the tipping point, but it's not, and things still keep going up, you're not going to buy back in, but now you're holding on a cash that's losing its value, and those growth investments are rising in value. So either way, I don't think the point is to say like, hey, buy and hold forever. You do need a disciplined investment strategy of like, hey, what is my portfolio allocation going to be? What is the weight of certain sectors going to be in my portfolio? And an example would be like, look, sometimes it backfires, right? So I remember summer 2021, I got out of, and they talk about this in the letter too, is like, hey, let's get out of names that like are good names, but we don't have the conviction in them as we have in some of our bigger names, right? So for me, I got out of a few positions because I wanted just some cash on hand, and I wanted to invest into companies that I had more conviction in. So the companies I got rid of, yes, I was in the green and I had conviction in, but I was like, wait, these other companies I have way more conviction in, so I just want to increase my position. So I think in November or October 2021, I bought more Melli stock, or Mercado Libre, sorry. I bought more Melli, I bought Sea Limited, Digital Ocean, some Tessie, and some Upstart. And we all know how that stuff has trended since November 2021. But nonetheless, I was like, hey, that's my viewpoint, right? Like, these are names that I want to have bigger positions in the long term, right? So in July 2021, I got out of certain names so I could get some cash and invest into these, right? So you don't need to look at it like, hey, buy and hold forever, but just trading to trade isn't what you should be doing either, right? Because that's you're not going to win that game, right? So it's more about, hey, what are the names you have conviction in? Obviously time horizon and all that does matter. But I think that quote from Ron, I think what he said, I think that's really, really great, is because you're going to miss great opportunities trying to trade and time the market and, chasing a trend or chasing a news event to monetize and profit on a trade like that. And, again, Howard Marks on this, another thing that Howard Marks said that I thought was really, and this is just a quote that they quoted in their letter from one of Marx's memo, is that, investors too often swing in the wrong direction. He counsels ignoring the noise created by the manic swings of others and focusing on the things that matter in the long term. And what I don't get is, like, so many people agree with this. It's like, why are we still dealing with this? Why are we still dealing with people trading, in a nonsense way? That's neither here nor there, but just something to think about. I think they made a great point there. But look, the lesson is, like, do not try and trade on short-term shit. I mean, like, you're not going to win. Most likely, most of you out there, including myself, we will not win trying to trade on short-term news events and short-term trends. And if you do, it's probably because you got lucky. It is what it is, right? That's just my opinion. And Bill Miller, another great investor, and look, I'm sure a lot of great managers have said this, but I don't know what letter this is from, but Bill Miller, another quote as it relates to, like, hey, do we want to trade in this environment? Bill Miller, we believe time, not timing, is the key to building wealth in the stock market. I think that is something that if you're an investor in 2022, especially, there's so much more interest in investing. There's so many new retail investors, so many kids in college and high school and young professionals don't know what to do. Understand that you have time on your side, and even though you don't know what to do, you have the biggest advantage, which is, like, hey, you don't need to do too much. You don't need to move around like a maniac, like a chicken with his head cut off, and you can just, hey, I want exposure to growth. I want exposure to certain industries. maybe some large caps. You can invest $1,000 into four. It's like 25% into large cap index fund, large cap into like some growth index fund, large cap into some small cap, and large cap into some industry index fund that, it's an industry that you're passionate about. And you can invest like that, right? And you don't have to do anything in the background. Hey, let me learn more about how interest rates affect things, affect the market. Let me read about individual companies, so on and so forth, right? But I don't think it's ever been easier for people, especially because there's so many more different avenues and different platforms, Wealthfront, Betterment, Titan, Fidelity, Robinhood. I mean, there's so many more platforms out there that are becoming easy to use that it can be enticing. Hey, let me go and try to trade and do a bunch of shit. When in reality, it's like Bill Miller said, time, not timing, is a key to building wealth. So, another part, the fourth point to this, and if I was a portfolio manager, I'd be pissed, is if imagine like large LPs or large clients, like, hey, like, is this a time to buy tech? Like, do we buy tech now? And I think what Michael Lipper, and I hope I'm saying your last name right, Michael, but I think that what I guess clients, or I guess they're, LPs, and obviously, look, it's probably very hard to stomach some of the losses that we're seeing day to day. And it's easy for me to say because my portfolio is not as large as the billions of AUM they have and maybe some of whoever their large LPs are. But you have to ask yourself is that, if the question is when will these sell-offs and rotations end, you have to ask yourself, what's causing the sell-offs and rotations? And the asset that's being sold off, is the asset itself still structurally sound? And is a thesis as to why I invested into that asset still hold true? And you have to ask yourself this, is that, hey, one, I will agree, and this might not be the most scientific way. I think what they say in their letter and what Michael writes is that, hey, there is some sort of, there is some sort of like reversion to the mean of, hey, maybe things were really overheated, overvalued, and maybe things are coming down to quote unquote earth, right? But here's the thing is that, and I'm just going to read this verbatim because I don't want to mess it up. Let me just highlight it so people watching can see it. And this goes back to what we were saying earlier, right? Is that these themes that when we think about these stocks, right, whether it's NVIDIA, AMD, Micron, DigitalOcean, Microsoft, Amazon, C Limited, whatever, right? And there's a lot of like medtech names in there too that I'm not too familiar with, but I'll get into that later. Is that folks in this generation who are, let's say, between like 10 and 20, is that Gen Z, I guess, right? Is that you're not paying with your wallet, right? You're paying with your phone. Forget about credit cards. You're paying with your phone, right? You might pay with your Apple Watch. How, like, Apple Pay, just tap your watch, right? You don't have to wait for a DJ to play your song on a radio. You don't have to wait a week to watch an episode of your TV show. And I'm reading this. I'm like, shit, he's fucking right. Everything's on demand, and these trends are real. So these business models over the past 10 years, almost 20 years now, and he's obviously talking about Netflix or things like Amazon and what have you in terms of e-commerce delivery, or Tesla, right? Is that when you compare it to the dot-com boom, where there are companies that are making literally no money, these are companies now that have real valuations, that have real cash flow, real earnings, and you understand the business models. You understand how that revenue is going to scale, how it can potentially scale, who are the end users, what is the revenue per user, what is the cost per user, what are our unit economics, and most importantly, how we continue to generate cash flow at scale. So regardless or not, the rotation out of these stocks and into value stocks, and there's a great sell-off, it might continue to happen, right? I mean, we don't know when it's going to end. You can't figure that out. But just because that's happening, you have to just take a step back and be like, hey, is the thesis as to why I invested into these companies still there? And it still is. So does that external noise matter to me? The reality is no. And there's this great example in some other letter about Peter Lynch. I forgot what company it was. Some steel company. I could be totally wrong. Some company that Peter Lynch invested into, and it kept going down, and it went down to $3 a share. And he was like, wait, this makes no sense. Why are people selling off in this company? They have great balance sheet, they have all this cash on hand, whatever. They're worth more than their stock price says. He's like, why are people selling out? And I don't look, for whatever reason, there was some fear driven shit going on. I'll try to find that example. Peter held on to it. And I think it was one of his more successful investments. If I didn't have more to go through, I literally would be just Google like Peter Lynch $3 share investment that went up to like $56 or something. But I'll find it for you guys. On the back end of this, of when will sell-offs and rotations end, is this, and this is really, really interesting, is in theory, when you're doing a free cash flow analysis and you project out free cash flows because you want to do a DCF, right? You discount things back with a discount rate. So in theory, with higher discount rates, sorry, let me just highlight this for folks on the phone, and I'll just read what Michael wrote. And so since price targets based on valuation multiples is a proxy for DCF analysis, in theory, higher rates, higher discount rates should lend to lower multiples and stock prices. But he makes a good point, is that multiples of what companies trade at aren't just going to be affected by rates, and rates aren't going to be the only things affecting them. And what it essentially says in here, and I don't know what data set they're looking at. I'm sure they went to CapIQ or FactSet or have like an internal database of comps. But essentially what it looks like, what they did is they were like, hey, let's look at market valuations. So what sort of multiples did these growth companies trade at across market cycles? So, hey, when the market environment was like this or that, what sort of multiples were they trading at? The genesis of what he's saying is that, hey, even if we take the median multiples across all these market sectors, these bucket of growth stocks would still fetch and trade at a lofty valuation, which means a lofty price per share, which just means that, hey, these stocks are not trading at what they should be at, even if they were trading, even if we apply median multiples across market cycles, because they're just not trading at what they should be, right? For whatever reasons, because people are rotating out, there's a sell-off, whatever, what have you. So I think this was a really sound point. And, this is so well written in such layman's language. I've read a lot of investor letters. Sometimes things get real nuanced and people start talking about terminal growth value and start whipping out formulas, but they have done a great job. So I encourage anyone to just read this letter. It's written very well, layman's terms, and it's common sense, right? It's really, really common sense stuff when you think about saying, hey, like, where have growth stocks traded at historically, even on average? We're not looking at extreme spectrums. We're just going to look down the middle across macro environments, right? So whether we're in a high interest rate environment or low interest rate environment, where have these stocks traded at? So I guess they could make it public. I mean, it's not the craziest information, right? I mean, you could, if someone had access to CapIQ or FactSet, you could just literally create your comps universe or your universe of comparable companies, or the same companies, right? Those same exact companies that you own today, what were they trading at in the past? And just apply different date ranges to them. And then you'd say, hey, you'd find out what multiples these different companies were trading at, right? So we could do that too. Just you need access to historical data. I mean, in theory, you could calculate it on your own too, because information's public. You just have to go and figure out what companies were trading at a certain time, back out, calculate equity, enterprise value, whatever. But looks like they did that, so I'm going to take them at their word, but I feel like I have a hunch that they are true in that. So, that is I'm going to actually end it right here, guys, because the back end of the letter, they go into growth versus value. They go into, more into their fund strategy. Actually, let me see if I can just kind of quickly go through this. Just because, guys, sorry, I'm just going to get through this. So, raging debate, I'm sure you go anywhere. Growth versus value. What is this all about? Is value stocks a trap? What is a value stock? What's a growth stock? Does there need to be such a clear bifurcation? My thoughts and my answers when people ask me this, I'm like, look, you should always be diversified. You should always have things allocated in a way that makes you feel safe and secure. And there's nothing wrong with being 80% growth, very aggressive, and 20% in more traditional large cap. I mean, technically large cap doesn't equate to value, but for the purposes of this, is that there is no reason why you can't be have exposure to value, right? With that being said, right now there's a rotation out of growth stocks to perceived value, and I say LOL to that because when I read this and he was like, as acknowledged above, we're experiencing a rotation to perceived value, safety, and lower risk. Earnings today versus more earnings and faster earnings growth tomorrow. However, I believe we're in a painful but typical sell-off, not a paradigm shift. Um, I think this is really, really important for folks out there to understand that you are sacrificing more cash flow in the future. More cash flow leads to more cash flow implies higher growth. Higher growth implies higher multiples. Higher multiples imply a higher share price. And this is probably one of the most well-written points I've ever read in my life. And it's right here. Market leadership will inevitably cycle, but we remain convinced that durable secular growth will lead the market more often than not. Our reasoning is quite forward, and please pay attention to this, right? Please pay attention to this. Longer-term market and stock returns are driven by growth in earnings and free cash flow and dividends. As we discussed, multiples fluctuate up and down, but always revert to the mean over time. So we need sustained, as opposed to cyclical or one-time expansion of a company's earnings to yield a reliably higher price. Durable expansion of a company's earnings or cash flow can only be driven by profitable top-line growth. So keep that in mind. So they have this great, so going down here to the next page is, and I don't want to ruin it for you guys, but there's a table that essentially looks at kind of growth stocks and kind of large cap stocks. But keeping in mind what he just said is that value stocks, if you think about it, a company like Coca-Cola, what more can they do to drive top line growth? Right? There's only so much a Coca-Cola, a Pepsi, Hershey, they can do to drive top line growth. And top line growth is what will drive, scalable expansion of revenue, of cash flow, of earnings, which will lead to an expansion of multiples. Like Coca-Cola is not going to trade at a multiple, 20x their multiple that they're trading at. They're just not, right? I mean, what else can they do, right? In terms of they have market penetration, adaptation, right? What are they going to do unless they start just pumping out brand new products, right? Like baby drinks. And I mean, I know they have all different products, but for the most part, there's only so much expansion that can occur there, right? Now, pivoting to the example that he has here, this is a really interesting table, right? At the top, you have growth stocks and the multiples they're trading at. You have their revenue growth, their margins, free cash flow margins, and underneath it, you kind of have like more large cap names. And what's crazy to me and what's interesting is that a lot of these large cap names are trading at the same multiples at these growth names, right? Of these, like, as they call it, digital transformation leaders. And that's insane to me. That's really interesting to me that I could say Nike, I guess, but like there's no reason Coca-Cola is trading at a similar multiple as like Nvidia or Google or, some of these other companies, right? I mean, look at each and every single one of these companies other than Coca-Cola, because they probably have a really good handle on unit economics. All these companies are low teens in their free cash flow margin, and not a single one of them, only Nike, had double-digit revenue growth. Hershey has 2% revenue growth, trading at a 30x multiple. Look at that, and look at all these digital transformation leaders. Off the charts, high teens, low 20s revenue growth, right? But more importantly, look at their margins. Their margins are almost double that. So first of all, revenue growth is almost 3 times higher. Free cash flow margin is 2x, but they're still trading at the same multiples. That's insane. I mean, look, granted, some of these valuation multiples are quite lofty. I mean, Nvidia is definitely pricey, but I mean, it is what it is, right? The market pays for what the market thinks, right? So all that to say is that, is there a value trap happening, right? I mean, some of these names should be trading at more premium valuations, right? But look, some would argue that no, Sajin, they're already trading at premium valuations, but they shouldn't be trading at the same valuations that some of these larger consumer staples. That, in my opinion, they shouldn't be, right? So Anyway, with that being said, to wrap this episode up, is the fund strategy. Now, new and young investors, I like literally, if there's one thing you take away from this, like this is what you need to take away from this. Is that this is really, really good, important advice thinking about the market, how you should approach stuff, right? We believe that sustainable secular growth will be the predominant foundation for longer term market leadership for both individual businesses and industry groups. If not every quarter or even every year, certainly over the long term. As emphasized above in all my investor communications, we believe. What the fuck? Why can't I? Whatever. Yeah, sorry guys. As emphasized above in all my investor communications, we believe secular trends, durability of growth, free cash flow generation at scale are the key factors that drive long-term stock market returns. That is why, despite the market environment, we relentlessly focus our attention on identifying powerful and durable secular growth trends that will drive economic growth regardless of politics, short-term economic cycles, or stock market gyrations, and the individual companies that are leading or capitalizing on those trends. It is a bedrock of our long-term performance. So, excuse me, that is something that I think all new young investors, young or old, if you're just getting into this, need to take away from that, right? And this is actually a great quote by Benjamin Graham, and this is, I think, is what this fund's underlying thesis is, right? And I've never heard it put like this, and I think this is so true when you think about it like this. What Benjamin Graham is saying is that, hey, the stock market in the short term is a voting machine, which you see short-term trends, fluctuations, external noise, interest rates, what is the Fed going to do, so on and so forth. But in the long run, it's a weighing machine, right? And what's really great here is what they're saying is that, hey, over the long run, companies are going to be they're going to be weighed based on their revenue, their profits, their cash flow, and that's how you're going to determine its worth, right? So this is really just conceptually to think about, is that growth businesses by definition get larger over time and gain weight. That is why we stress finding businesses that will grow faster for longer and generate heavier loads of earnings and cash flow as time goes by. That is really, really important, is that growth businesses grow because the market they're in hasn't been penetrated. Maybe there hasn't been as much customer adaptation. They haven't penetrated, obviously, not only to consumers, but end clients, what have you, use cases, whatever. So as that expands, by definition, they're growth businesses, right? Top line growth increases year over year. Your free cash flow increases year over year, and that just equates to loads of free cash, loads of earnings, which leads to multiple expansion, which then leads to a higher share price. So I think this is the most well put letter I've read in a while. The way they broke this out, I think, was really, really fantastic. And something else is that a lot of these kind of mega trends that they're focusing on right here, all of these companies in these sectors really have revenue growth rates that are multiples of the general economy, right? And if you look at it, they have a little chart here at the bottom that shows, hey, this is our fund, and these are the growth rates of the revenue growth rates of our companies, and these are the revenue growth rates of comparable indexes, right, or our proxy indexes. So they have the Russell 3000, S&P 500, Russell 3000 growth, and as you can see, that the revenue growth rates in their funds, and obviously the companies that they're invested in, are materially higher, in some cases double, triple, quadruple, right, depending on the time frame you look at. So again, proof is in the pudding. Don't fall for the trap. If there are strong growth businesses with good business models, strong top line growth, that will lead to free cash flow, earnings growth, multiple expansion, share price, right? So anyway, that is episode 7, Finance Musings, guys. I will talk to you guys later next week. I am going to talk about NVIDIA or DigitalOcean or something. I don't know. There's a lot to talk about. So anyway, guys, I'll talk to you later. Peace.